I'm Julie Hyman. That's Brad Smith. Brian Stasi remains on assignment. He's going to be back tomorrow. Let's take a look at what's going on with futures because we had $1.5 trillion wiped off of just the S&P 500 yesterday. Yeah. Never mind the other major averages as we saw the worst day in 2 years for U.S. stocks, sparked by that worse than estimated consumer price index number. And this morning, we're a little touch and go, Brad, right? Yeah. I mean, we had futures dip into the red briefly for the Dow. They're back in the green. S&P futures hanging on to those gains as well. And NASDAQ futures also higher. But let's take a brief look at what happened yesterday, shall we? You want to run through the numbers here?
100% here. Taking a look at the Dow Jones Industrial Average, and across the major averages, as you were mentioning a moment ago, the worst days that we had seen for these major averages here in the U.S. since June of 2020. And you think back to what was taking place at that time at the onset of the pandemic, and now with this 1,276 point decline yesterday, even with some of the waffle activity that we're seeing here going into the market trading session in the U.S. here today, it could shape up to be another, once again, touch and go. Perhaps not a ton of conviction out there as of right now, but we'll actually see where that comes into play. The S&P 500 on a point basis, this was the 5th worst day for the S&P 500 ever. And so all of that in context as we move into today's trading session.
Just speaking of context, quick thing I wanted to mention, look at the 5-day chart for the S&P 500. We've just taken a round trip. So it's not like we've gone into a new bear market, right? You could argue we're still in the last bear market, but I guess what I'm saying is this is a round trip. It's not, a more significant erasure of some of the recent progress that we've seen for the S&P 500. So just a quick note on that. Let's look at some of the other asset classes quickly here. Looking at the 30-year yield up to 3.52%. That is the highest since April of 2014. The 2-year at the highest going back to 2007. So strength there. The dollar index actually coming off a little bit here this morning. That's the year to date. But if you look at this morning, actually seeing a little bit of weakness in the dollar and looking at some of the other assets. Bitcoin is not bouncing back, Brad.
It's not. And we've seen so much of these speculative assets really continue some of that downward movement. Of course, there was a lot of news earlier on this week that we had brought to your attention with regard to the Ethereum network merge. However, even as we move forward, you're still going to see even some of the more speculative assets under pressure. And there was a point yesterday where from peak to trough, you had seen about this 11% move to the downside in Bitcoin. And so continue to keep a close eye on BTC USD as well as ETH USD as we move on.
Two quick things we got to tell you about. First of all, crude oil futures still showing some strength this morning, interestingly, although it's been a volatile session. And then quickly want to move over to the heat map and to look a little bit more closely about what happened yesterday and specifically the sector action, because really, it was communication services and tech just far and away. Everything was down. Broad-based decline. Only 5 stocks in the S&P finished the day higher. But it was clearly tech that took the worst of it yesterday.
Yeah, absolutely. And we were focusing in on consumer discretionary yesterday as well. But keeping the conversation on tech for right now, technology stocks took a beating yesterday. And particularly with NVIDIA being the worst decliner, dropping 9.5% and seeing its worst drop since March of 2020. You saw Meta drop 9.3%. That was its steepest drop since February of 2022. And so for all of those major tech giants that we've been tracking here, NVIDIA has certainly been a lackluster summer for NVIDIA. But you think about the losses that we had seen yesterday specifically, it also goes to show still how much of the pressure is going to be on tech to prove itself and the ability for the price to earnings ratios to actually match up. And especially on the forward PE multiples that many of them had been given, we're expecting largely for some of these guidances to have to continue to come down. And we're already seeing that come out at least this morning, at least through one of the guidances in Nucor, which we'll talk about a little bit later on. But this larger thinking of where you're going to see some of the corporate earnings have to be revised into the downside even.
Right. And how much is already priced in. So we were showing the market cap drops in those various companies. Apple's market cap drop yesterday of about $154 billion is the worst ever, one of the worst ever that we have seen in terms of market cap losses. Right, because Apple is so big. So here's a list of the other market cap decreases, and some of the other ones have been Apple, but it just gives you an idea, puts yesterday in context, partially because of the size and importance of technology in the market and the sheer size and importance of Apple itself. So there's yesterday, right? It's at the top of this second full screen that we saw that $154 billion coming out of that market cap. So yes, valuations have started to come down.
Right.
But if the earnings are also going down, then maybe valuations need to come down a little bit further, depending on which of these companies that we're talking about.
And it's also paired with, if we are to see the Fed be even more aggressive in a rising interest rate environment, tech is particularly, it has more exposure to that rising interest rate environment because that means that the access to capital and cash particularly is less easy to come by. Less accommodative environment means tech is very reactive when you do see the Fed be more hawkish in its policy. That's exactly what the CPI print yesterday was pointing towards and what the markets were trying to price in as best as possible. And so here you're seeing, at least pre-market, where we're seeing and watching, at least for most of the names, some of these moves higher, but fractionally, and not erasing all of those losses from yesterday.
Right, exactly. And the fact that we saw the futures kind of dip into the red a little bit, I don't know what's going to happen today. We'll have to keep track.